Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 25th, 2018. I wanted to do an update on the broad markets. I haven't posted any public broad market analysis recently because a lot of what I've done has been, if I've covered the broad markets, I've included other sectors, commodities, bonds, things that are normally or are either active trade ideas, potential trade ideas on the site, but it's premium content reserved for members of the site. So I wanted to get something out there for both members to update my thoughts on the broad market as well as those that follow the YouTube page. All right, this is a 60-minute chart at ES. The bottom line is for the last couple of weeks, and a reason the market analysis has been on the light side. We've been in this sideways trading range. This, in fact, is the largest sideways trading range since this whole volatility party kicked off back in late January. Since late January, as I pointed out, the pattern has been these what I call micro rips and dips here in the market, micro trends, we call them, and not a lot of sideways trading action. We've had little periods of consolidation, of course, but then those were just brief consolidation periods, like this little flagging action we broke out. So this is a little bit different. Um, so what to point out right now? Not a lot. I don't want to spend too much time on the 60-minute charts. This can go either way. We won't trade sideways forever. Watch this line right here. This is again the ES, the S&P 500 E-mini futures. This is a 60-minute chart. I'll get to SPY and QQQ in a second. There's a level to watch, an uptrend line. I think it's going to go next week, and I think we're going to go down. That's my expectation. I think we're poised for a pretty good pullback in the market here. We'll see. I could certainly paint a bullish picture if I wanted to, and I'll point out those levels. I mean, anything could happen. I'm not screamingly bearish right now. I'm what I call cautiously bearish, but I do think the next trend that's going to emerge out of here will be to the downside as of this point in time. If the charts change, in my opinion, will change, but that's it. There's a level to watch right here. It's about 26.98. This purple line that I'm highlighting right now. Then this level here, and that's 2683-ish roughly. So let's see what happens. So the story, just before I move on to QQQ and NQ, the story is this. I trade these divergent highs and lows. We had a divergent high here, followed by a correction. We had a divergent low here. You can see all the divergences marked on the 60-minute chart. So they panned out well. This was a bearish rising wedge. We had this breakdown, and we had negative divergence right here. At this point, there was a smaller wedge, another correction. So this is my go-to time frame. I'm going to get to the 60-minute charts of SPY, and I'll show you really what I see there. Before I do that, let's just touch on NQ because I do like to trade NQ, and it's an important tech is NQ is very tech heavy, and technology is also the largest component of the S&P 500, so it's worth mentioning. Here it is. So this is sort of this line here, as well as this one down low. This is sort of a broadening wedge pattern, megaphone pattern on this 60-minute chart. So let's see which way this breaks. We're at the top of that now. We do have divergence. I should draw it here. Small divergence right here. We had divergence at the low right there. So, that's what it's been, back and forth, and looking for these divergent highs and divergent lows. I need to draw you that divergent line there. That's the wrong tool. Click on the line tool. There we go. That was that most recent divergence. So we'll see what happens, but that's my expectation is for some downside next week. Look for, there's support right there, 68.52, and these are all potential targets and support levels there. All right, let's look at for you SPY traders and QQQ traders. What it stands out to me, you can see the momentum indicators are flattening out. So I try not to put too much weighting on them when they start to flatten out when you're in a sideways trading range. But I will mention that we at this point here, if you follow the crosshairs up, we did have negative divergence for the first time in a while, actually for the first time since back here on the 60-minute chart of SPY. So right there, negative divergence right here, and there's the divergence, extremely overbought. Right here we had a divergent low, positive divergence, and so now we have negative divergence. So that's what I look to trade. And this is one reason I'm looking for some downside next week. Again, these lines are flattening out. I like to see clean separation between the lines. Well, we actually had clean separations, but right now we're flattening out. So this movie will have to be continued next week. And remember, it's a 3-day weekend coming up, or Labor Day or Memorial Day, and so, anything can happen over the weekend. You have an extra night of overnight risk. Right here, we had a bearish rising wedge on QQQ. It played out. I showed you that same wedge on NQ. We have potential if we punch up. If we happen to pop up, I don't think it'll happen today. Anything's possible. But on Tuesday, if we pop up sometime in the morning, maybe gap up or have any strength early next week, and then reverse, what we're going to do is you can see the indicators are lagging. So what I've done is space these lines a little higher. So any pop in QQQ, any marginal new high will be a divergent high unless the Qs can burn on through those divergences. In other words, take out those previous reaction highs. So that's what the 60-minute charts are looking like. Now let me just get to the long-term charts and we'll wrap this video up and I'll share my thoughts on where we're headed. I'm going to focus on SPY because the S&P 500 is much more representative of the U.S. economy and the U.S. stock market than QQQ. SPY is made up of 11, or the S&P 500 is made up of 11 sectors. You have more coverage, representative coverage. It's more balanced. You're not so top heavy in your top components. And QQQ or the NASDAQ 100, I believe the weighting in tech is over 50%. So although tech is the largest component of SPY, you also have other sectors that you do not have in the NASDAQ 100, such as financials. I want to get to those. So I'm going to go through SPY and just a handful of top components, paint the big picture, and just drill down to the daily charts real quick, and I'll wrap it up there, and I'll show you, why I'm making the case for a correction coming up here in the coming weeks. Apple, we'll get to in a second, but before we get there, SPY, here's that long-term uptrend line off the 2009 lows. You can see it coming in here, and this is what we've been dancing on. So I have two trend lines here. I have this, what I call alternative. I think is a very significant trend line. It comes off the 2016 lows, captures a lot of reactions. We broke down below it right here. This was a stick save. These were a couple weekly tests of it. This is the big red candle right here that we took that out. And the fact that that candle is so large and red impulsive like that helps to validate that as a support, an important technical level, that trend line. And that's what happens when trend lines break. And since then we've tested for weeks now. These were intraday breaks. Don't, when you have that skinny part, the candlestick shadow or a tail, that's just what happened intra-week. All that matters is how you close a week. So look how many tests. For months we've been testing that trend line. And I want to make something clear. A member in the trading room brought this up earlier this week about how in recent weeks and even months I've said that I've used the phrase that we're only a bad day or two away from breaking those trend lines, and he had interpreted that to be that I thought that the market was going to break those trend lines in a day or two, and that's not the case. What I mean by we're only a bad day or two away is I'm referring to a bad day in the market. This is a bad day. This candle is a bad day. This is a bad day. So a bad day, in my opinion, is 3% or more. Let's just call it roughly that. And if we had a couple big red candles, that's going to take us below that trend line. And then what's going to happen more than likely, and this is usually the case, this is the last straw trend line. And there's some lows. We still have to challenge those recent lows. But I do believe that if we break that trend line, things are going to start happening very fast. So you should have a trading plan, whether you're bullish and long, you're bearish and you want to get short, or you're already short. Have a plan to add to your positions, because from my experience, if this trend line goes, or when it goes, whether it's next week or 6 months from now, it's going to go with conviction. Things will start happening so fast. You'll have one day after another. That's the nature of a breakdown, especially a well-watched level. You have day after day of selling, and the most longs want to say, "Oh, I can't sell now. My XYZ position or my portfolio is down 5% today alone. I'm going to wait for a kickback rally. Wait till this support level will get a bounce." Normally the market's not going to give you that opportunity. The market likes to trap longs just like it likes to trap shorts on during reversals. So just be aware that the selling could kick in pretty quickly. So there's SPY. Yeah, I do see this PPO is starting to curl up. Now it's been flattening out. You can see that it looked like it was poised to curl up. It's flattening out. These are pretty significant buy and sell signals, bearish and bullish crossovers on the PPO. So keep that in mind. If we get a last bullish cross with clean separation. This is not clean separation. We had low volatility. I stay away from using the PPO. These crossovers when the lines are flattened. I like to see crossovers after clean separation. There's a bearish cross. The SPY dropped by 5%. There was a bullish cross, told you to get long, and there was the last time you had clean separation. There was your bearish cross right there, right about there. And we continued, we went a little higher, then continued lower. So that's the bigger picture. Those are the levels I'm watching, and of course those recent lows from February and was it March or early April. Let's look at a few of the leading stocks, and the story is going to be the same for the most part. You have technology continuing to hold up this market. It's leading the way. There are some companies, a lot of these mega caps are already in their own bear markets. Some sectors have already broken down, in my opinion, like the financials. I'm going to get to that here, but it's all about tech. When tech goes, the market goes. This is the largest component, again, of S&P 500 and the NASDAQ 100. And Apple is, to me, very clear. This is a clear, simple chart. I have all these big divergences on this weekly time frame marked, and although it doesn't look like much, most of these drops were significant. I use log scaling on my chart, which I think is imperative when you have a security that's gone from about $12 up to almost $200. This is what arithmetic scaling looks like. It renders a different technical picture. So I like to use log scaling. It puts all these moves in equal percentage terms, visually. So here's a 45% drop. So again, it may not look like much after that divergent high. This drop was significant. I had to turn these trend lines off, or I'm going to grab them, but you can take my word, it was double digit. And here we are, well-defined uptrend line. So Apple is in an uptrend, but these divergences warn of a likely impending trend change. Momentum indicators are still headed up for now, but if we start to roll over, and Apple has some room to go too, by the way. We have quite a bit of room in Apple, almost, I used a little slope there because we probably wouldn't get there in one day. Call it about 8 to 9% just to get back down to the trend line. But if it does, what it'll do, if it does that soon, it will confirm this negative divergence by giving you a bearish crossover on the PPO. And again, just the scope of that the divergences and that trend line, if it breaks, I see nothing less than a move down here to about 134 in Apple, which to try to quantify it for you, and I know that's heresy for Apple bulls, but that's about a 28% drop, and I think we'll see that this year sometime in 2018 most likely. All right, let's look at a few more. We'll go through a little quicker. Amazon trend line. There's an uptrend line coming off the early 2015 lows. We have overbought. You can see down here on the RSI, we're coming off overbought levels with negative divergence. See the divergence there. And here's another one that's doing real well. It has a way to go just to visit the trend line, but that's the thing. This one hasn't visited that trend line. There's about a 19% drop if it started to play out for, if it started to correct soon. We have 19% downside until we do. And this is when you want to buy Amazon. I'm not saying that, with this divergent high, you got to watch out. It could crack, but it hasn't visited that trend line since back here in October of 2017. We had a near tag back there in February of 2016, and this is where that trend line starts. So, with the divergence and everything, and also I'm noting on a lot of stocks, it looks like we have a potential buying climax. A buying climax is when you see after an extended rally or after a correction, when you see a surge in volume. This is indicative of a buying climax. It usually marks a top. Just as after a sharp sell-off or downtrend or bear market, you have a what they call a selling climax. You can see the volume bars surge there. There was a selling climax there after the sell-off, et cetera, et cetera, et cetera. So you can go back in time, and that's another case to be made that Amazon, may have put in a top, or maybe in the process close to it. Okay, we'll go a little faster. Microsoft, same story, uptrend line, uptrend line. You can see what happens when these uptrend lines break. These are primary or major uptrend lines. So Microsoft, like a lot of companies, it's in a secular bull market or a cyclical bull market, however you want to look at it. works its way up in these sharp trends. This is when you want to be long, and then it has these periods of consolidation where it works off overbought conditions and builds up the energy. Price catches up to earnings, or I should say, earnings catch up to price, and then you have the next thrust up, the next trend. Then that trend breaks. You're in for a period of, that's a year and a half or so of sideways action, followed by some more sideways consolidation, then the next trend. And as you can see, just looking back historically, this is a 10-year chart showing the entire bull market. Those trends don't go forever. In fact, the current trend is very long in the tooth, and the fact that we have this negative divergence here at the top tells us that that trend is likely will likely end soon. Alphabet, GOOG, same story, uptrend, trend line break, consolidation. So you can see, same with Microsoft. These are the market leading stocks. Works its way up. This one's hugging the uptrend line right now. We've been dancing on that level for a long time. So again, we're just a bad day or two away. 995-ish on Alphabet, symbol GOG, looks like a key level if that trend line goes. And then, if that breaks, I could give you some targets, but let's not do that in this video. There's another version of it. This is a Class A shares. You can see a different trend line that I used, and bigger divergences right here, these negative divergences. So not a good looking chart. I mean, it isn't an uptrend. So again, you can't knock it. There's no sell signal on it right now, at least not a long-term sell signal. But if we break below trend, there could be. Facebook, I have two alternative trend lines there, but you can see the divergences there. Berkshire, this is what I wanted to get to. This is one of the largest financial companies. Just about all the large financials have broken trend. They all have these trend lines off the early 2016 lows, well defined. They've broken down, back tested for a couple weeks, and now pretty big red candle. You do need to see, to put the nail in the coffin, I think, for the financials, you need to see the recent lows go. We've been finding support all year around this 192-ish, 193-ish level. You want to see that go on a weekly closing basis, and you'll know when you see it. You get a big red candle, like a lot like this big green candle here, or any one of these red candles. So there's Berkshire. We'll look at a few more, and then we'll just go to the daily chart and wrap this video up. JP Morgan Chase, another leading financial stock. Here's your trend line, broken below trend, back test, starting to roll over. But again, to really give up the ghost, you want to see not just one, but you want to see all the financials take out those recent lows that they've found support on since all the volatility started earlier this year. So there's JP Morgan Chase. ExxonMobil, it's in its own bear market. It has been. That stock topped back in 2014. It's not anywhere close to the highs. From the 2014 highs, it fell about, let me grab that. I think it was up closer to 40, about 37%. And even today, 4 years or so later, we're still down 24%. So this is a stock that peaked. I said it back then. I've been bearish. I think ExxonMobil put in a generational top, at least for some time to come. We'll see. Maybe not, but you can't argue this doesn't look pretty. And this is one of the top components. Used to be the largest stock in the world. Not so many years back. There's JNJ, ugly looking chart, negative divergence, divergent high on the weekly chart, big impulsive sellings since then, and we're right now on trend line support. So this is the first tag of the trend line in a while. So you could get a reaction here, a little bounce. You may or may not. During a bull market, a bull trend, you want to buy pullbacks to support, because that's usually when it's very fleeting. The stock usually bounces and rallies hard from there. In this case, we haven't seen that yet. Let's see what happens. Also note that the trend indicators are bearish. They're pointing lower. The PPO, after this divergent high, it's now below the zero line, well below the zero line. RSI hasn't even hit oversold yet. Usually you get these oversold readings and pullback to support. If the charts confirm, you might go long for a bounce. So this one could bounce, but if it does, that's what my point is. A lot of the stocks that have either broken support already, or those that are dancing on support, they've been doing so for months now, and that shows you that you don't have that demand of buyers that you had over the last few years. Maybe it changes. Maybe they kick in soon, but as of now, I'm not impressed. This market's not going down much, but it's certainly not going up. It's off its highs, and a lot of these, almost all these market-leading stocks are off their highs. There's Bank of America, clean bearish rising wedge on the weekly chart breakdown. There's that same support level we're dancing on, give or take $28. You can see there throughout most of the year, but still well below trend after a divergent high, and that chart looks bearish. Visa. This one is actually a component of XLK, I believe, the technology ETF, although we know it's a financial service company. You can see these corrections in the past. You can see the divergent highs that I have drawn out here. This divergent high back here, that was good for a 30% drop, 17, 22, 18. And I don't see a single reason why we are not looking at least a double digit, probably well into the double digit drop once this trend line goes, especially after this divergent high. In fact, this is one, I think you can short it here. I have some on the daily chart. I can make a case to short this one soon and swing it down at least to that trend line, if not more. WFC, Wells Fargo. I don't. All right, we'll stop here and then I'll get to the daily chart. This is Intel. There's a big bearish rising wedge. When the semis break, tech breaks. Semis tend to lead technology, and this, can see, clean pattern here. Negative divergences. Look at that RSI. Look at the divergence there. So Intel, it's in an uptrend, and it is until it isn't. And the thing about breakdowns, when you have these divergent highs, once the market has topped or a stock has topped, especially after a divergent high on the weekly chart, and then you get trend line. You zero down your entry on a daily chart, of course, even a 60-minute chart. But my point is that the reversal is fast and swift. You look at these red candles; they don't let you out once that stock has picked a top. And this is that initial suckers rally, the kickback rally, where everyone thinks, okay, we dodged a bullet. There was a sharp correction. Dip buyers get in, and then when that low gets taken out, that's where they realize they're wrong. So that's what you want to look for on not just Intel, but a lot of these companies is, that initial shot across the bow right here. There's your divergent high. There's your kickback rally right there. Let me draw it out for you. Divergent high was right there. Wrong tool. Initial kickback rally, and then we took out the previous lows, and that started a downtrend there. Big correction in Intel, and I think the same is coming very soon in this stock again. One more. We're here. Walmart. This is one of the largest components as well. It's in by definition, it's already had a bear market in just a couple months here. Less than 4 months, the stock has dropped about over 25, about 26%, and you can see the momentum indicators are still pointing lower. It's at support, but it's probably going to come eventually. Maybe get a little kickback rally here soon. It's certainly getting stretched, but we haven't hit oversold yet. There's a trend line there to watch. So let's look at the daily chart, and we're going to wrap this up here. Let me go back just to SPY and QQQ real quick, and I'll show you what. Forget about every other line up on the chart. What I'm looking at now, and I mentioned this the other day on the site, are these clean, first of all, I like clean separation on the PPO line. We're going to focus on the PPO, these high-level bearish PPO crossovers. So again, when the lines are flattening out, the signals, you tend to get a lot more whipsaw signals, but when you have pretty good separation, here looked like we were going to have a crossover, but we didn't. The lines bounced, and we got a crossover there. Then we went in, we corrected. We had a bearish crossover here, we corrected. We had a high level bearish crossover here, and you can see, we all know what happened in early January or late January. The lines looked like they were going to cross. They bounced right here. Boom, we got a crossover shortly after that top there. Looked like we had a little whipsaw signal, but here it is. This line is curling down. So this is the PPO, very similar, close cousin to the MACD. If you don't have a PPO on your chart, use a MACD. You'll probably see something very similar, but that line is coming down quickly. You can see the rate of how this line's turned down, and it's poised to make a bearish crossover. Sure, can it kick back? Absolutely, anything's possible, but these are pretty solid sell signals by themselves, but used in conjunction with everything else I'm looking at, you may want to heed those warnings if you get that. I think it's imminent now. I think we'll get it next week or in the next week or two, but we'll see. QQQ looking a little bit better right now because the lines were poised across, had a little kickback, but anything can happen here. So again, this is what I'm watching for. Here's those previous crossovers. You can see the arrows. I marked the arrows where we had these crossovers, and you can see the corrections. Again, I have a lot of lines on this chart, but that's what I'm looking at, and we'll just go through a handful of the stocks. I'll go back to the SPY to make it more representative of the entire stock market, not just the tech-heavy NASDAQ 100. Here's Apple. You can see the PPO poised to make, it's actually pinching right now. It might have made a bearish cross. I can put up the histogram. It doesn't matter. If I put a PPO histogram, you'll see there it is. We do have a crossover. When the lines go red, that just shows you when they cross. But again, let's not split hairs. Sometimes you get a little whipsaw signal. Close enough. Any more downside next week? So Apple has been in this trading range like the NASDAQ 100. No surprise. It's the largest component. So if we break down next week, it's going to confirm these bearish PPOs, high level, clean separation, crossovers. Amazon already crossed, already made a a bearish crossover. Microsoft's looking okay, but from the PPO pointing up, but you can see negative divergence. Look at these. Look at the divergence here on Microsoft on the daily chart. Alphabet poised to make a bearish crossover on any more downside. So again, what happens next week, in the next week or two? Maybe these lines bounce, and that's the bullish case. So if you're bullish, you want to see the market, of course, not just for this PPO, but also for that recent trading range. You want to see us break up and above there. And if you're bearish and or short, you want to see confirmation with these bearish crossovers here. And again, we can go down the line. Let's see, hit the wrong button there. Go to Facebook, pending. Berkshire already made a recent bearish crossover. I can see the lines have crossed. There it is. JP Morgan, the lines recently crossed. And again, go back in time. Look for, this is not clean separation. We had clean separation right here. We had clean separation here, but I'll tell you that one didn't play out. They don't always play out, but there's one with clean separation. Here's one with clean separation. And we went sideways to down after that point. So down the line, ExxonMobil just made a bearish PPO cross. J&J looks not too bad here from this perspective. You have bullish divergence, one of the few stocks, and I think I showed you that one at long-term support as well. So if nothing else, it's probably, if I had to be long one of the top components of SPY, it would be that one with a stop not too far below. Bank of America, bearish cross. I'm going to end it here. Just saying the same thing over and over again, but it's important. This is what goes into my analysis. So we'll see what next week brings. Maybe more of the same, more sideways trading. But I'm leaning towards a downside break of the recent trading ranges and further confirmation on these daily charts. And again, remember, we're still well off the highs on the weekly charts. I mean, off the highs in most stocks, including a lot of those big leading tech names. So again, we'll follow up next week, see what kind of developments we have, and go from there. This has been Randy Finney with the Right Side of the Chart. Have a great weekend.